Afternoon. Thanks very much, Sonia, and thanks to everyone for sticking with us here on the third day as our Hollywood Squares repopulate with a bunch of additional folks who've been part of the sessions over the last few days. This is really a chance for everyone who's been such a faithful participant to use that Q&A function at the bottom of the screen to ask questions that relate to anything that happened over the last few days, any session that spurred a thought, or after the thing was over and you were thinking about it and thought, gee, I'd really like to know something that wasn't addressed. This is a time to present that, and we've really got a great assembled group here to try and answer them. So that Q&A function at the bottom of your screen is what we'll try to monitor here in order to get those questions answered. And then I think just for the benefit of those who may have been in some but not all of the sessions, whoever we kind of pitch one of these questions to, if you could begin before you answer by just identifying yourself by name and who you're affiliated with, so folks will know kind of what they're getting in terms of those answers. I just want to acknowledge my co-moderator here, Nick Ratty from CohnReznick, who's joining us here in the center of my Hollywood Squares. So we'll try to field these things together. And okay, and we also got some questions that were submitted offline in connection with registration or afterward that we'll try and address. It seems like a number of those, and one that just came in here on the Q&A, all relate to our legislative panel from Tuesday. And so, Beth, I think you may be the only representative of that.
I know, I was looking around.
But I think there are probably other folks here too who might want to chime in or have some insight into some of that. So it sounds like there's renewed interest maybe among some folks who didn't attend that session about the HTC Go legislation. Specifically, there was sort of a general question about it. And then some folks had some more particular questions about the likelihood for changes to the HTC program under the Biden infrastructure bill. And then somebody asked also if there are any specific efforts being made to return the HTC to a one-year credit. So maybe we can throw those out there and see if anybody wants to speak to those.
Well, I'll take a stab at a few of those. So the Biden infrastructure program, first of all, isn't legislation itself. So it's just sort of a broad strokes about what kinds of things the president might want to see in legislation. So there's nothing in there that I know of that is specific about historic tax credits, but there's a lot of community development initiatives. There are a lot of green elements of what is being proposed, and as we know, it's much better to reuse and recycle than build new. So that's a repurposing historic structures is a very green approach to community development and redevelopment. The HTC Go does not propose switching, getting back to a one-year credit. As much as all of us would love that, that is not in any of, well, it's not in the HTC Go legislation. There's always a, I am not on top of every piece of legislation. So somebody might have introduced a bill to go back to a one-year credit, but it's not the one that the industry is really following.
I see there someone made a comment about that subject to say, if there were pushback in the Senate on increasing the credit amount to 30%, would industry be better off instead pushing for a single year credit, but over 5 years? And so why aren't we doing that? And, I think maybe some folks here have some insight into that, but I think that this was sort of a function of what the legislation that changed, that saved the credit in the first place and kept us from being eliminated, came up with this 5-year credit. So I think there's a thought that it's going to be difficult to push back on that, that's actually a heavier lift than increasing the credit amount.
David, or go ahead, Forrest.
There is a lot of truth, I think, in what David said. And I'll also note that the Historic Tax Credit Coalition, which has, I don't know, the 80, 100 most active people in the industry. And this question comes up from time to time. In fact, it came up at the last meeting. There was a discussion about which one we should be going for. And there seemed to be overwhelming support for not reducing basis as compared to the 5-year as compared to eliminating the 5-year phase-in. As to why you couldn't do both, I don't know, other than the reason that David expressed, that they just felt like a lot of people lined up behind that. And so, people don't want to then pull the rug out from under them and say, well, thank you for that, but now we've decided to go back to this.
I think that the supporters of the credit on the Hill have been very clear that they've thought, to Forrest's point, going back to that would be much more difficult than introducing new opportunities to improve the credit. And so they said, basically, if you're going to bring us a bill, please don't bring that to us in a bill, because we're going to have a hard time selling it.
Pivoting back to Beth's point about the infrastructure proposals from the administration, I don't know if it was the same person or someone else who was asking, what can be done amongst kind of industry advocates, people that are users of the HTC program, to promote its inclusion in some way in whatever infrastructure proposals move forward. I suppose that's kind of a strategic coalition.
So the coalition has been asking any of us involved in the industry that have projects to reach out, obviously, to the congressmen and the senators and get them on Congress side. There is a bill from Representative Blumenauer that could be signed on to, and they've been asking us to sign on to it as much as possible, as many of the members of Congress as we can get. And there's a sense that a companion bill will be coming out of the Senate at some point, and that would be obviously the same ask when that happens.
Plainly, being able to demonstrate increased hiring and things like that. I mean, you really want to put together a nice little package about the project, which is in a particular congressman's district, and then present it to them and say, aren't you in support of this? Wouldn't you like to come down? We'll take pictures of you here and show, this wonderful renovation, all these new people got employed, that kind of thing.
And the boost to the potential 30% credit is really around COVID relief, really that the industry was affected by COVID, and this boost is temporary, but is something that's needed at this point, whether it's because of delays in construction, costs, supply chain costs, whatever it is, the 30% really is needed to support, the setbacks these projects have had during COVID.
I'm just now realizing the challenge of moderating this freewheeling session, because we get questions on whatever subject somebody wants to write in on, but I want to try to keep the conversation having some flow and sense. So folks, if you don't see your question being answered right away, it's because I'm trying to weave a thread to the discussion that makes some sense. But I'll pivot away for a moment from the legislation to a kind of an investor couple of questions that, Tim, maybe you'd be willing to weigh in on. One was specific, I think growing out of your session or just now about opportunity zones, and asking whether an HTC investor would increase its HTC investment pricing merely because the project was located in an opportunity zone.
So I think when you think of the landscape of HTC equity investors, as I'm just thinking off the top of my head, I'd be hard pressed to find one who would increase their pricing because it's in an opportunity zone. I think you'd have to have a unique taxpayer with a unique set of circumstances different from the current crop of typical investors.
Certainly opportunity zones are far more noted in individuals than in corporations. And most of the historic tax credit investment community is corporations. So right out of the box, you don't find, as Tim was suggesting, you don't find as many banks and the other kinds of investors having all that much in the way of capital gains. I also think they tend to think of this as that is why they're investing at all, because they had their opportunity zone break, and so don't expect us to also give you more money.
Right. Yeah, and I think, the way I've seen opportunity zones, they're just a part of a capital stack. And so it's other people that are bringing those dollars to the table. And so it's just, from an HTC investor standpoint, it's just looking at a capital stack and saying, okay, we're getting some equity from the sponsors this way and some of it through an opportunity zone vehicle, but it doesn't really increase benefits in any way to the HTC investor just to have opportunity zone in the deal.
There is a nice matching though, because the requirement to rehab the property with as much as you spent on the property is very, very similar. There's a slightly longer time frame, but it's very similar to the historic tax credit requirement. So there's a nice matching there.
This one might be.
Forrest, isn't it? Wouldn't it be? Sorry, David.
Go ahead, Bob.
And Forrest, wouldn't it be true, Forrest, that the vehicle by which that corporate investor would invest in that project, it would have to be already an opportunity fund. They couldn't choose to enjoy those benefits after the fact. Is that right? It would have to be a fund up.
You have to set up a fund to make your investment, but it is very easy to set up a fund. It doesn't have to be, I mean, not in any way diminishing those of you who have set up funds. I appreciate that. But an entity which has a capital gain could set up its own fund and make the investment through that. So it's not a hard process to do.
But it has to be in advance. It has to be thought through prior to the transaction going forward.
Yes.
Yeah.
Here's one that really a number of folks here might have some experience to share. I think, we did talk the other day on our markets panel about pandemic impacts on projects that were, already past financial closing, maybe under construction, haven't delivered yet. And so the question came in, have we seen many projects having placed in service dates that were pushed from 2020 to 2021 or later due to COVID construction delays, and how were investors responding? So I'll throw that open to whoever wants to weigh in.
We're certainly seeing those projects. I think actually I was working through one with Tim Karp and Chase in upstate New York. And the project took advantage of the extensions under the COVID relief bill on placement and service till March of 2021. So we definitely are seeing them. And that extension applies to the ability to keep your 1 year credit in terms of being grandfathered into the one year historic credit.
And I'd add, we're certainly construction was impacted in a lot of markets. I mean, it was really interesting to see, the portfolio across the country, which projects were and were not impacted, but a number of projects, particularly ones that were more market rate in nature, definitely had construction stopped or paused for an extended period of time. So we're seeing those place in service dates pushed out. We're really dealing with them on a case-by-case basis, where we tend to be a little less sensitive around timing. So if it's something like a once in a lifetime pandemic that's pushing back your placement and service date 6 or 9 or 12 months, we're understanding about that and not holding everyone to the letter of the law and adjusters and things of that nature, because it's a once in a lifetime event that was outside of a development team's control.
Yeah, I would just echo the point that Nick made. We had a deal that we were chasing a place in service date in order to benefit from the grandfathered in single year historic credit. And the extension helped. And we just had to sort of get creative with our local partners in terms of pulling certificates of occupancy in order to meet that deadline.
I see we got Patrick Robertson joining us, and Patrick, we might want to throw a question to you that we got some answers from already, but I see you've got some news from the Hill. Let's pivot to that.
Sure. So, David, the reason I was late is because I had a series of meetings with Team Maryland today, our advocates from Maryland, who talked to both Senator Cardin's office and Senator Van Hollen about Senate introduction of the HTC GO Act. And Senator Cardin's office told us this morning that he's going to go ahead and introduce the HTC GO bill in the Senate next week. which is great. In Senate speak, that means maybe sometime in the next 3 weeks, hopefully next week, but if it takes a couple more days than that, that's okay. The only thing that's a little funky is they may have to split the temporary and the permanent provisions into 2 different bills. But they're going to introduce a bill or a series of bills that looks almost identical to those House provisions. So we'll be sort of one step closer to building the pyramid toward passage. So I just wanted to let everybody know that we got good news from our Maryland meetings today. And to the extent that you'd like to have similar great meetings with your members of Congress, let us know and we'll help set you up.
Well, that's great news, Patrick. And I guess a reminder for sort of a coalition for a commercial rather for the coalition that really the Historic Tax Credit Coalition is the industry group to help advance the program, advance this legislation, and make sure that we have something to work with going forward. Patrick, let me just present to you a question that we talked about a little bit just before you joined, and that had to do with the potential for pushback in the Senate on the 30% increase, of the credit amount. And the questioner said, would it be better if industry were trying to push instead for a single year credit rather than why aren't we doing it?
Yeah. So the reason we're not pushing for a single year credit is because Republicans have told us they're not willing to go there. One of the lines in the not sands. One of the lines in the sand that people have drawn on the Republican side of the aisle is we're not going to go back and undo pieces of the 2017 Tax Cuts and Jobs Act, right? And so that means we're not going to take the corporate rate from 21 to 28 or 25 or any other number. We're not going to change capital gains rates. We're not going to change estate tax. We're not going to go back and alter any of those things. And one of the things that bill did was move the HTC from a 1 year to a 5 year. So one of the reasons you see sort of the Rubik's Cube of ideas that we've come up with to put value back into the HTC is because that was the ruling that we were given by House and Senate Republicans alike. Now, that being said, could this happen in a Democratic only reconciliation bill? Maybe. But the one thing that's been true about the HTC, as long as I've worked on it, is it's been bipartisan, right? It's a program that was created in the Reagan administration or permanentized in the Reagan administration. We were saved in Republican tax form. Democrats have tried to enhance us. Republicans have tried to enhance us. We've always had a bipartisan bill. And the idea and the strategy behind this is to always be a provision that everybody likes, right? And if you start sticking your finger in somebody's eye, it gets a little bit less like that. So we have absolutely had some pushback on the 30% bump up. But if we've had volume 10 pushback on that, we've had volume 50 pushback on going back to a year, right? And then the one thing I'll say about the 30% bump up, people need to hear what's wrong in the industry and that COVID isn't over, right? I mean, part of that pushback is we're not doing any more COVID relief. We've done enough. We don't need to do any more for you or for anybody else. And that's sort of another line in the sand that's been drawn that's tough to manage when you're looking at no hotel projects, no office projects, labor shortages, high construction costs, bank shortages, or financing shortages, all the things that we've all spent 3 days talking about, right? But it's a tough nut to crack when people are trying to get past that and you're trying to say, we need more. So that's what's going on with 1 year versus 30%, right? And one of the big things about the 1 year is eliminating the basis adjustment will help with some of those 1 year issues.
Absolutely. What though, obviously there's just a practical element to this. We hear you, we understand what happened when we got saved, but is there any substance or policy reason why Republicans are so adverse to going back to what existed for so many years in terms of the 1 year credit?
Only that they did it and they don't want to change it, right? The credit isn't better at 5 years, but this is not unlike, and this is going to sound a little pejorative and I apologize, but this is not unlike bedtime for your 5-year-old, right? If bedtime for your 5-year-old is always at 8 o'clock, and 2 or 3 nights in a row you allow it to be 8:30, and then one night you allow it to be 9. Then when you try to go back to 8, it gets really, really, really tricky, says the father of young children who's made this mistake, right? But if you think about it this way, if you allow HTC to go back to a year, then why can't the corporate rate go to 25? And why does new markets still have to be permanent? Or I guess new markets wasn't made permanent, but why does it have to have a longer window? Why? So this is sort of a finger in the dike exercise, right? Hold back the water. Don't let any one leak out, because if you do, the whole thing collapses. And I think if you have an honest conversation with your Republican senators, they'll tell you we have no opposition to the HTC going to 1 year. It's just that we have a blanket rule to try to protect what we thought was a good balance, right? And we saw that. The HTC community gave up the 10% credit. It went to a 5-year credit, which wasn't ideal. We tried to get the elimination of the basis adjustment. We didn't quite get there. We'll try again, right? But that's why we're making other changes to try to get there, because this blanket rule this isn't something that we can convince Republican Senator X or Democratic Senator A, frankly, or Z, or whatever the right letter is, that this is good policy, so you should get rid of all your other convictions in the rest of the text, right? We are subject to the proverbial elephants in the room who are not going to change their view on that.
Right, understood. Well, one other policy-related thing that came up in these questions, Patrick, was about the Biden infrastructure proposals and whether there is any room in them or opportunity for advocates for HTC to get some, I don't know whether it's a legislative vehicle at some point in the future or any way to benefit HTC in these infrastructure proposals.
So that's what we're shooting for, right? We're shooting for an infrastructure proposal that makes our HTC changes. And when you look at the Biden infrastructure proposal, depending on how you look at it and how you add it up, it spends about $4 trillion, maybe $6 by the time it's over, but maybe $2 in about 18 pages of text, right? And so there's a lot of details that aren't in there, right? And when you talk to the administration and to some Democrats, they say, when you read through and it says community revitalization or, affordable housing or some of the other buzzwords they use about development tools, that's when they're talking about the HTC, right? They don't call out each credit individually, but they're talking about the kind of things that the HTC does. But what's really going to happen is somebody's going to take that 18 pages, right? Or 20 pages or 50 pages, whatever it is, and turn it into legislative text, right? And when they do that, that's when they're going to draft the HTC provisions. The people who are going to do that first are going to be the staff of Chairman Richie Neal of the House Ways and Means Committee. The same staff that wrote the Moving Forward Act last year that included all the provisions of HTC Go. So I feel really good. I can say this to this group. I feel really good that when pen goes to paper, you're going to be able to see HTC enhancement provisions in whatever infrastructure bill comes out. Now, we talked a lot about bipartisan versus partisan in the panel, and I won't get back into that. I think there's degrees, but I still feel really good that our supporters are well positioned to put our provisions into the next package.
Well, obviously a lively topic and a moving target for sure. So once again, a commercial for the Historic Tax Credit Coalition. For those not already familiar with it, it is the industry group that advocates on behalf of the program. So look them up, get involved, and you'll be able to get these kind of dispatches from Patrick and know more as things evolve. Because I think we're going to have a real opportunity in this Congress. I guess this is an active time, we think. So I'm going to turn to I think another investor related question. So maybe Claudia or Tim would like to speak on this one. And that was regarding asset class. The question is, what will it take for HTC investors to get interested again in hospitality projects?
I can start. I'll come with that. To be honest with you, I think I may have done the only hospitality project that was scheduled to close last year. And in fact, it did. And in fact, it was shown, it was one of the examples in terms of modern buildings being using historic tax credits, the Marcel Hotel. Albert, that's your project. We did that project because we had a long-standing relationship with the developer. We had done a variety of other historic tax credits with him. He's always performed. And stating the obvious, he has a strong balance sheet and a very strong record. So we were able to get comfortable with that. We are in fact looking at another deal, which has a lot of bells and whistles and has a lot of local support. And the way it's structured, it's something that we can get comfortable with. Am I going to be doing a lot of other historic hospitality projects this year? It's going to be a few. It's not going to be very many, maybe one or two. But again, in this current environment for us, it does have to have the sponsor who not only has a strong record, but in fact has a strong relationship with the bank. It is almost impossible to start a new relationship with a hotel in 2021.
I would add, we're not big hospitality folks, but I think it comes back to, to underwriting, right? Of what Claudia is hinting at in terms of looking at, strong sponsorship, but then also what are the rest of the capital markets doing as it relates to hotels right now? I mean, I'm sure that there's not a lot of other capital outside of historic equity going into hotels. And if it is, it's got to have conservative underwriting associated with it. So I think that, generally it's not a favorite asset class coming out of a once in a lifetime pandemic, but as long as it's got strong sponsorship, relatively conservative underwriting, I think you'll find an investor for it. It might be Claudia, it might be someone else, but I think if it's underwritten the right way, where you're not trying to max everything out in terms of revenue, expenses, and leverage, you're probably going to find an investor out there.
I think that Tim makes a good point, and that is, honestly, when it comes to these kinds of projects, you secure the hardest piece first, and then everything else will fall in. And we would not be the leaders on that, but everybody needs to belly up to the bar at the same time.
Sure. All right, so brace yourselves, everyone, because I think we have a couple of technical questions relating to HTC and LIHTC that grew out of the last session. So this sounds like a Forrest, Beth, Nick possible answer. I don't know if you guys saw this in the Q&A box, but I'll read from this question. It's following up on the last piece concerning HTC LIHTC investors being the same in a lease pass-through structure. And the question is, what is the tax concern in the industry, given that the RevProc references LIHTC, stating that prohibition of investor holding an ownership interest at both landlord and tenant entities does not apply to separately negotiated, distinct economic arrangements, and seems to contemplate an investor using both?
I think that we start with the notion as to whether or not you're getting away with something if you have a single investor, because a single investor theoretically should do a single investment in one entity, claim both credits, and be stuck with the basis reduction. So structuring the transaction so as to have two investments at both landlord and tenant seems to be being done purely for a tax. We needn't use the word avoidance, but for a tax purpose. And people worry about that. I'm not saying it's impossible. It's just in the great scheme of, how far should we push things? I think people say that's the line. That's where they draw the line.
Yeah. Sorry, go ahead, Beth. Go ahead.
No, I'm completely with you, Forrest. It's incredibly bad optics. Even if we could absolutely fit it right in the RevProc box. The business question of why are you doing this is really hard to answer.
The question of whether you have a real lease, what's the purpose of this master lease if you have the same folks on both sides or same participants in both sides? I mean, there's a lot of optical issues with it that present risks that – folks just aren't willing to take, quite honestly.
And I was just going to add from the investor perspective, that's what I was alluding to in my panel, right? There's a wide range of interpretations of this. I think the most simple way for everyone, investors, developer, so you're not dealing with some issue down the road, is to have separate investors there.
Well, and at the end of the day, regardless of, the optics mean a lot to investors. And I can honestly say, I could have a technical explanation of why I can, and I will say, well, that's nice, but it's not happening. So I'd rather be upfront about it and say, that's not going to be where we're investing.
And the risk is yours. I mean, the investors are taking the tax structuring risk.
Hey, right, this is
So,
absolutely structured.
he who has the gold makes the rules. Rule.
I'm gonna say the same thing, Beth.
Well, and there's alternative options, right? You don't have to take that risk. There's safer investments out there following the letter of the law. Why take that risk on? It's not worth it.
I think Rob makes a really excellent point. We're hearing that in a lot of questions that come up in this community, in the tax equity community, that there are enough opportunities here that are, it's not safer or more conservative, but just don't have the bad optics. So why would I want to push things?
Kind of on the same theme. I'm not sure if I'm quite following this question, but let me put this out there and see if you guys can offer something. It says restructuring historic LIHTC twin in a state where there, quote, needs to be a single investor for both HTC and LIHTC. They say, example, New York, by default, must the transaction utilize single tier structure rather than lease pass-through?
That's really probably a state credit question, I think, actually, because New York is not going to require you to do something for federal purposes.
Right.
Yeah, and that state, the New York State LIHTC credit used to not be certificatable. It is now. You don't have to be the same investor. And the state historic, you do, but you can use refundability. So I think that's probably the nature of the question. There's no requirement per se, though, because you can use a separate investor that doesn't have the tax appetite who can just use the refundability mechanism.
Fair enough. And I think this next question kind of follows on something that we spoke to earlier, which is about the requirement for a reasonableness opinion relating to the historic side of a historic LIHTC investment. And Tim indicated that, yes, he would require that for the historic investment. So somebody asked, wouldn't it be illogical to think developer fee and the pass-through base rent on a LIHTC deal would be reasonable when compared to a market rate transaction?
Double negative really threw me here. I read that question a half dozen times. I think perhaps those of us in the low income community are used to the notion that development fees and certain other fees, because they're so common in the industry and so consistent with qualified allocation plans and so on, are by definition reasonable. All the tax professionals know that the IRS has some line in the audit guide that says, we don't care what your state agency says. We reserve the right to dispute your development fees. So I think that, but that leaves the one other question, which is the difference between the lease pass-through, which is where Tim was saying that he would get a reasonableness opinion, and the single tier deal, where I think we tend to not seek a reasonableness opinion. I think if you do a single tier structure and you do reduce basis on account of the historic tax credit, everybody says, oh, we don't need to worry about, because fundamentally the purpose of the revenue procedure is, are you a partner? And nobody really worries about whether or not a low-income housing investor is a partner. So I don't think in that circumstance we see people worry about it. Once you get into the two-tier deal and now you've got a separate historic investor, it makes a lot of sense for them to want the full suite of what they get when they do an historic investment. And I think that's why Tim said that they would get a reasonableness opinion.
I would call this next one a softball, but it's whether Nick, Beth, or Forrest would like to swing at it, I'll leave you to do it. It was, what is the consequence of not having a DRO, that's a deficit restoration obligation, as losses are reallocated, but HTC follows profits? So I guess sort of maybe.
That sounds like one for me, because I'm actually sort of a tax accountant. What are the consequences? Potentially the consequences of not having a DRO is that when the partner's basis, tax basis goes negative, they have to be allocated gross income. And that's a pretty geeky tax answer, but that's the consequence. You know, if you are really in a situation where there's no DRO, for sure, and it's sort of a combination of tax capital and tax basis, and those are not exactly the same thing. So
I think this was a leftover from our panel, Nick, right? This
Yeah.
question came
Yeah,
up when
go
we
for
ran
it.
out of time to address it. If you start with, let's suppose you had a $10 million project with a $2 million historic tax credit, and the investor was paying 85 cents. They paid $1.7 million. And as a result, they have a capital account of $1.7 million, and now you have the $2 million reduction. So they go to minus 300. I think the person is asking the question, where in the code does it say that just because their capital account goes to minus 300, that something fails? And I think that is a completely legitimate question. There isn't a rule which says if you can't keep your capital account positive, then you're not allowed to take the tax credit. I think some of this spills over from the new markets area, where people have always felt that your capital account cannot go below zero, and they make a big deal out of it, and they make sure that your capital account doesn't go below zero. And it's sort of made its way into historic. And as a result, I think that people think along the lines of what Beth was saying, that you're going to have to allocate something to bring your capital account back up to zero, or do a DRO. And so people do DROs so as to assure that your capital account doesn't go below zero. And I would say at the same time that the tax professionals would have to agree, there is no provision in the code or regulations which says you do not get tax credits if your capital account goes below zero. There just isn't such a rule. But everybody treats it, you know, nobody wants to poke the bear. I think people don't want to see that happen.
Forrest, I agree. I mean, especially in a situation where the historics are allocated according to profits, there is nothing that says you need basis in your capital, your tax cap, or tax capital for that matter, to take the historic credits. It's just sort of interesting.
So a kind of a deep topic that maybe can be, you know, it's better illustrated. You know, I appreciate Forrest trying to put some numbers to it, because obviously when it comes up in a deal, you look and see whether somebody's going to go negative or not, and then try to think, okay, what are the implications of that happening? Another one that's kind of an evergreen, it comes up every once in a while, is please explain how individual investors could benefit from historic tax credits and the structure of these transactions. And they reference passive and non-passive income, you know, I guess by way of limitation on the ability of an individual to claim the historic tax credit.
The individuals, by virtue of the passive activity rules, first of all, they could be real estate professionals. So that's one way to get into this. They would already know about this, though. They don't really need to hear our explanation. Real estate professionals would already be so active here. Everybody else probably needs to have either be a limited partner in some businesses that are throwing off profits, or be in the leasing business, because leasing is per se passive, be in an old real estate deal that is fully depreciated and is now throwing off phantom income. Those three things are the most likely places where an individual would have lots of passive income and could therefore take advantage of the tax credits that would be thrown off here. As everybody knows, you can't use your lawyer, doctor, whatever income against this, but you can use the passive income that you might have from limited partnership investments, from leasing investments, and so, you know, that's the most likely place you're going to find these people.
I mean, in addition to the passive activity rules, you have the at-risk rules, that you have to think about with individual investors. They can be difficult to structure and sometimes impossible to structure around, quite honestly. So it's just, again, another instance where you have to really think about it up front, involve the right people on the professional side to think through the issues, because there are a lot of complexities that don't come up in your normal, I'd say, normal real estate transaction.
Historics are at least much better than several other, renewable credits are much, much worse on the at-risk rules than historic is. Historic, because there are special rules for real estate investing, is reasonably loose. Development fees can be a problem, but most borrowing that comes from, either government entities or people in the, banks, people in the business of lending money, as long as it doesn't exceed 80%, pretty much works in this marketplace. And so, the at-risk rules are not as problematic as they are in some other transactions. But Nick's right. You got to make sure that, because it's really bad if you don't pay attention to the rule and you screw it up.
And then it can also get complicated if you have a partnership structure where certain partners want to take advantage, certain individuals in the partnership want to take advantage of the historic credit and others don't. And figuring out a way for those credits to be shared amongst those individuals, rather than doing a syndication structure where you bring in a Chase or a Bank of America to take those credits.
One last thing we didn't talk about, and it is the at-risk rules, and maybe this is what you're thinking of, Nick, so I apologize. When you do the two-tier structure, individuals investing in the master tenant is the most complicated thing imaginable and pretty much doesn't work. They have to guarantee the rent stream between the master tenant and the landlord to the extent of twice the amount of the credit plus 10%, so 50% in the historic world. You would be saying to an investor, if you want to do the two-tier structure, that you have to guarantee 50% of the rental stream, which is just, I cannot imagine in my wildest dreams convincing someone in a limited partner context, how'd you like to also guarantee the rent stream? So it is by definition going to stick you with single-tier deals, not two-tier deals, and that matters too.
Could you explain why that is? What is it that requires that guarantee by individuals?
That is a throwback from, this is that whole bit about the law is in effect prior to 1990 is where the lease pass-through method comes from. And that is in the code and the regulations from prior to 1990. And so it's just this wacky rule that, somebody must have come up with as a way to limit, this kind of thing with individuals, closely held businesses, trusts. I don't know that.
Sorry, I was just going to say the formula is literally spelled out in the code. It's right there, so it's tough to interpret it any other way, quite honestly.
Nick and Beth, do you guys ever see a deal where the sponsors say, "Look, we'd really like to try to claim the credit ourselves"? You kind of show them this requirement of the lease pass-through. And they say, okay, well, we don't want to do that. Could we use a single tier and allocate it amongst our partners in the sponsor team? Or is it, I think people always wonder, they always think they have the facts that will make it work, and I never see it work. I wonder if you guys do.
If the sponsor wants to use it, I've only seen them do a single tier. If people want to use this, the lease pass-through structure really is beneficial related to the gap treatment of these investments. So there's really no great reason to do a lease pass-through. Again, unless there's one member of the group who can use the credits and nobody else can. But usually what we see is everybody thinks they're going to use the credits, and then they realize, holy smokes, these are passive credits, or I don't have enough tax liability, and 3 minutes before the building's about to be placed in service, they're scratching around to find an investor. That's usually the way this works, not not a more thoughtful process.
I seem to remember there being a president of the United States who got stuck in that position. That is supposedly what happened with the post office building in Washington, D.C.
I've probably worked on 4 of these master lease transactions with individual investors on the master tenant side in the past 3 years. I'd say that those the purpose was because there was only one individual within the sponsor team that could utilize the credits. And, it's important to note they were also participating on the landlord side, usually not in a majority way, right? In the less than 50% capacity in the landlord. And they were willing, because of their risk on the landlord side, and they were signing up for the economic risk in the transaction anyway, willing to sign on to the required guarantees of the master lease. So it happens, it's rare, I'd say. You have to have the right set of circumstances for it to make sense.
Yeah. Well, I'm happy to say I think we have addressed all the questions that have come in. We really appreciate the large number of folks that are staying with us through the few days. But I don't feel any obligation to tie up people's day any longer than needed. I do have a little bit more housekeeping just to thank Lynn Resnick as our co-presenter, our strategic partner, the Historic Tax Credit Coalition, our sponsors, Bank of America and Chase, and a reminder that the world is starting to reopen, and with it, IPED. For the first time in person, Philadelphia, October 21 and 22 on LIHTC dispositions, and the Historic Tax Credit Summit will be in person in 2022, June 16 and 17 in Washington, DC. So we will look forward to returning to in-person conferencing very soon. Thanks very much to everyone here, panelists and participants. And remember that this program is only as strong as each of the people using it. So we encourage you to call your congressman and let them know how important it is, so that we can protect it and preserve it and advance it. And wishing everybody a good day.
Thank you.
Thank you.